So again, we're going to figure out our depreciable value, which is just cost minus salvage value. And now we're just going to determine it based on units of production. So a good example of we set as a company, we set the policy on how we're going to depreciate our assets based on asset class. And so asset class might be equipment, it might be the building, the land, etc., but land isn't depreciable. So many companies do straight line because they think that best represents how expenses are recognized. But some companies, namely manufacturing companies who make, let's say, books or shoes, may determine that time isn't the best indicator because their machinery may have a useful life based on the number of shoes or the number of products they expect to produce. And so for some products, think of the warranty for cars might say good for 10 years or 100,000 miles. Well, if you expect to drive that 100,000 miles much quicker than 10 years based on your business model, you may decide to do the number of miles as the depreciation method rather than the years itself. Same thing with shoes. A piece of machinery might state that it can make 1,000 pairs of shoes, 1,000,000 pairs of shoes, or good for 5 years. If you're expecting to make 1,000,000 a year, it might make more sense to use the total units of production. And our depreciation expense is going to be just the depreciation per unit by the number of units produced. So not too complex, same calculation to figure depreciation cost per units, cost minus salvage value over the total units produced. And then we just go for it. So same here, 9,000, 36,000 shoes. So we figure out how much depreciation expense per shoe. We just take the 9,000 divided by the 36,000 shoes. And then if we use 7,000, we determine the depreciation expense by the 9,000 divided by the 36,000 multiplied by the 7,000, which you'll see here. 9,000 divided by the 36,000 equals 25 cents a unit times the 7,000 is your 1,750. So again, it's relatively simple calculation, just making sure you memorize how to derive it. As you can see, the method here is more sporadic because it mimics exactly how shoes are being produced, and which could be different. So it's not an even form of transfer. And so if I asked you on an exam, what type of method has an unpredictable, what depreciation method has an unpredictable pattern of depreciation expense, you might say units of production. It's unpredictable. And so you can see here, 7,000. Again, we'll just walk through this for the recording. How is this calculated? This is the end book value. We know that our salvage value is actually 9,000. We can't get above that for our accumulated depreciation because we know it's only 9,000. And so then we take our depreciation for the number of units, 7,000 times 25 cents. We got the 25 cents by dividing the total amount of units, 36,000, into the 9,000. So the depreciation expense, 1,750. That's 7,000 times the 25 cents. And then our accumulated depreciation is just the sum going forward. And then our end book value is the 10,000 minus the 1,750, and so on and so forth until we get our 1,000 at the end.